First, I want to share the screen. Okay, you all can see the screen, huh? I will off my photo. Okay, first and foremost, uh, Nora, can you see the screen here? Nora, Eunice,
Yeah.
can you see? Can you see the
Yes,
screen?
I see.
Okay, today only 2 hours. Seminar 3. So we'll do chapter 7 and 8. Then tomorrow, another 2 hours, 2 to 4. That is 9 and 10. And we will break for New Year. We will come back on the next Saturday. Next Saturday, that is on the 17th. That's the revision, and this is your final exam. So we got another 1, 2, 3, basically 3 classes. Okay. So today we will do chapter 7 and chapter 8. Now, chapter 7, it relates to banking and management of financial institution. So in this chapter, we will see how the banks do their job, do their managing of their jobs. Okay, so that is in chapter 7, and then briefly in chapter 8, we are talking about central bank, which in this case in Malaysia is Bank Negara, and the Federal Reserve System, which is actually in US. We just want to compare. Okay, so we go back to chapter 7, banking and financial institution. So of key points here. Now, last time you may have studied, you may remember your accounting, whereby asset is equal to liability plus capital, which is in the balance sheet. So on the balance sheet on the on the left hand side is all the various type of asset, with fixed asset or current assets. And on the left hand side is the liability, whether long-term liability or short-term liability, and of course the share capital and the retained earnings, the profit accumulation. Okay, this is what you have studied last time. So it's the same as in the bank. Okay, except that bank is a little bit different. Okay, from a normal business. Right. So let me sort of make it look bigger so you can see. Right. But when you look at the bank balance sheet, now when you put in money into the bank, when you take your currency notes or you transfer money to the bank in your current account or something like that, okay, the bank will treat it as an asset because you give money to the bank. Therefore, asset side here is the reserve or cash item, which is the asset. Now, what do you mean by reserve? Certain portion of the cash item can be transferred to reserve. Now, reserve means reserve for the bank to use. The balance is cash. So in Malaysia, we have a statutory reserve 2%. Okay, in US maybe it's around 10%. What does that mean? That means, let's say you put in 100 cash, they will put in 2 in the cash account and 98 in the reserve. And later on, the 98 they can lend out. They only need to put in the law 2%. Okay. Now at the same time, since you put in money, so this is their cash and reserve. Now the corresponding side is the liabilities. So if you put in a saving account or you put it in your banking, your check account, this considered as a liability to the bank. Why? Because the bank have received your cash at any time when you close your account, right? The bank owe you the money so that you can take out from this saving account, or you take out from your checkable deposit, or you take out from your time fixed deposit. Okay, so or whether it's a short term or small one or large deposit. Okay, now you may also have, right, over this side here, the bank may have used some reserve to buy some US government or agency bonds. okay, or some state of Negri Sembilan or state of Selangor, then they have bought bonds from these states. So we have this. From the reserve, they will take up some to put into the buy. At the same time, wherever they have balance, they can also put to loans. The bank can give loans. Now, when the bank gives loans, it becomes an asset. Now, why is it become an asset to the bank? Because those people who take loans must pay back to the bank. Therefore, the bank treat this as their assets when they give out loan. So now you look at this side here, and you look at all this side here. Now you can see a little bit different. Okay, so maybe the bank owe 11, 49, 60%, 70, so 72. 72 is deposit of one kind or another, which the bank has to pay back if you close your account. Of course, most of us don't close your accounts. We have some money in the bank because we do not put our money underneath the bed. So we put our money in the bank. So this is a more big portion of their liabilities. Now, with that amount, right, and also maybe bank borrow from other banks, okay, or bank borrow from the central bank, or also because the share capital. So this total liabilities is used to finance their cash, their bonds, and also their loan. Now you'll notice the loan portion is very big. So commercial and industrial loan, business loan, 13%. Real estate, the bank give out loans for you to buy house. Consumer loans, maybe the bank give you money, will give you the Visa card for you to use. When you use, it's actually a borrowing. You borrow the bank by using the bank Visa card or MasterCard, right? So therefore, it's a loan. Interbank, bank may also lend money to another bank, and then maybe others. So maybe this is anything else is others, and here maybe the bank building the bank cars the bank maybe have some land or whatever it is. So now what we see is that the bank will take in money from you and lend it out. What's the problem? The problem is 11 plus 49, 60%, 70, 72. These 72 belong to the rakyat or to the companies in Malaysia, for example. They can close their account. In other words, the bank is borrowing short. Short means what? Short term. And they lend out long term. Because when the bank lend out, let's say for industrial loans, maybe you have to pay back within 1 year or something like that. Real estate, maybe they give you 20 years or 30 years loan. Consumer bank, Visa card, sometimes you only pay the minimum balance, and so forth. So what happens is that they borrow short, they lend long, long run. Okay, a long time. We use the word short and long. So if suddenly these people start to draw the money, whether your checkable deposit or your saving deposit or your fixed deposit, long term or short term, right? If they want to close their account, even long term fixed deposit, they can close just below earn the interest. That's all. Okay, you forfeit the interest. You can still draw out the amount. So if you start to draw the amount, go to ATM or start to issue check, the bank don't have enough money. Why? Because the bank cannot ask these people to pay immediately back. Because all of them got contracts, loan contract with the bank. And this is maybe 30 years or 1 year or whatever it is. Right? So therefore, when you start to draw money a lot and the bank cannot have enough money because they cannot get from here, what do? They take from some reserve. If still not enough, they sell off their bonds. If still not enough, they have to go and borrow some more from other banks, or they have to increase their bank capital. Okay, so why does the bank do such dangerous thing? Because the interest here 8 to 9%, the interest here will be 2%. So the difference of interest is how the bank makes the profit. So don't be so happy when the bank give you a loan. Don't say the bank is very kind. Actually, the bank must give loans in order for them to make profit. Okay? So another key part, these are all the liability. These are the various definition. So there's one activity. How does a bank acquire their funds? So who is here? Nora, you're here, Nora. So how does a bank get money? Nora, can you answer? Nora, are you there? Eunice, are you there, Eunice?
Yes, sir.
So the question is, how does a bank get their money? Eunice,
Hi, sir. Can you come again?
how does the bank acquire funds?
From the interest that they gain for the loans and from Bank Negara. Is it true?
Yes, besides, they get their money from checkable deposit when you open the current account with them. They get their money when you put in money in the saving account. They get money when they get people to do the fixed deposit. Okay? That's how banks get money. Okay? Now we talk about basic banking. So let's say initially somebody put in the bank, give the bank 100. Okay, you the Raya give. So what happened? The bank accounts will show bought cash. You bank in money, 100. There's a liability because the bank have to pay you back when you close the account. From this bought cash, they will now transfer it to reserve. They just pass a journal entry. Okay, from cash to reserve. And then from reserve, they now can pass the entry to loans. That's about it. There's nothing much. Okay, now general principle of bank management. This is talking about commercial bank, not central banks. Okay, like this type of bank is what bank, Maybank lah, CIMB Bank lah, RHB Bank lah, and all that. So what is their principle of bank management? There are few principles. These are there. The first one, the bank has enough ready cash to pay its depositor when there are deposit outflow. When you want to close your account or when you draw out your money from ATM, some money, the bank must have enough money. That is the first principle of bank management. Okay? Why? Because you put in your bank, you put your money in the bank for safekeeping. So you should be able to draw your money. So therefore, the first principle is the bank must have enough ready cash to pay its depositor when the depositor take out their money outflows. Okay? Now, the second principle of a bank, the bank manager must pursue or follow an acceptable low level of risk. Okay? By acquiring assets that are low rate of default. Now, what are the assets? Like, for example, loans. When the bank give out a loan, this is an asset because those people who borrow a loan must pay back to the bank. Okay, so the second principle is the bank manager must follow an acceptable level of risk by acquiring assets that have a low rate of default. Now, when you give out loan, when a bank give out loan, it wants to make sure that you can pay back. Okay, that is important. So they will only give loans to those people who can pay back. So how do they know you can pay back? So for example, if you are an employee, you want to go get a housing loan, 1/3 of your monthly salary is used for bank loan repayment. If your salary is 10K, they don't give you a loan that you have to pay back 10K every month. You cannot survive. Roughly, okay, if you have a salary of 10K, they will give you a loan that will tie back to 3,000 ringgit per month payment to the bank. Okay, so they want to make sure you have enough money. Now, what about a business? When a business borrow money from the bank, well, the bank will only lend to those business that have good profit or good potential of future profit. They don't want to lend to those business who have no profit, right? A business that have no profit means the business cannot pay back the loan. So the same thing is for individual, you must be working, and that's why sometimes they say, do you have a 12 months EPF slip to show that you're working for 12 months, something like that. They will also ask you to do a medical checkup so that you don't die so early. If you die so early, who's going to pay the balance of the bank loan, right? And they ask you to maybe buy an insurance, okay? So that if in any case, if you die, the insurance company can pay back the bank loan. So these are the requirements. So the bank will always try to find people who can pay back, then only give loans. Okay, that is a normal general principle. No bank will lend to people who have got no security, no job, no business, the business that has no profit. That makes sense. Okay. Next, another principle is to acquire funds at low cost. Which fund has the lowest cost? Checking account. Checking account or current account in Malaysia wording, checking or current account, you put your money so you can issue a check. The money inside the account bank has got no interest. Okay, but whatever balance down there in the current account, the bank can lend it out and get profit. The second one is saving account. Saving account is very cheap, right? Maybe 2% per year, right? So they try to acquire funds from checking account and also from deposits. The fourth principle, the bank must decide how much capital is needed. Of course, the more the capital, if a bank got a lot of capital money, no need to give so much, no need to take in so much saving account deposit to pay interest because the share capital is huge. Okay, so but if you have a huge share capital, right? Shareholders must subscribe to your bank shares. That's one of the issues. Okay, so you must at least have a minimum. In Malaysia, you need to have how much? 2 billion. 2 billion share capital if you are a commercial bank. Okay, by law. Okay. Okay. So now we'll look at this one. We'll start with this one. This is the liability. Depositor has put in 100 million and bank capital is 10 million. The total is 110. And is used to finance loans of 80 and buy securities. Maybe they buy bonds, the bank buy bonds, or the bank buy shares in normal companies for 90, and this reserve is 20. Right? So this is very huge. It is about 20%. Now some banks put extra reserve in case a lot of depositors suddenly draw cash. Okay, so if that's the case, this 20 million cannot earn profit. You understand? Only this 80 million and this 10 million can make profit. Okay. So if suddenly somebody draw 10 million, therefore now the reserve can go from 20 to 10. At the same time, the deposit, right? Yeah, okay, for example, this one is out of 20 million. I'm sorry, out of 20 million, 10 million is taken out to give increase in loan. So still can okay. Can they give up This 10 some more, can you make loans 100? If they make a loan 100, reserve is 0, then how to pay back when people draw the deposits? Yeah, cannot, isn't it? But if they still got 10, maybe still okay, right? Got 10%. So this is not available. Now, if you have used your reserve, which is against the law, to go to 90 million, and then people try to draw out of 100, they draw 10, the reserve is 0, your bank is still can function, right? But the law say you must be at least 10% or 2%, then the law will come up to you. Okay? Then the Negara will come up to you. So this is not wise. So how do you solve when you're in this kind of situation that people have drawn out, you have lent long already, and you have borrowed short, right? 90 million now. So how to solve to come back to this 10? There are a few options. You're a top up because the law says you must have 10% reserve, for example, in the US. So the first option is, right? You go and borrow from another bank overnight, 9 million. So this fella, another bank, let's say this is Maybank, you want to borrow from CIMB Bank. CIMB Bank is going to charge you interest. So they will pay interest, and this interest here is higher than this deposit interest because CIMB Bank want to make a profit around 3 to 4%. Versus saving here is only about 2%. So this is first option. And it's easily done because this is money market. Overnight you can do. Other banks, just inform to other banks, and the other banks, with the extra money, they will lend to you. Option 2, sell some of your security from 10, sell 9 to give back to reserve. Now, selling of security sometimes takes time. Okay? If you sell a security just before the bell, the stock exchange closing, maybe sometimes the money may come 1 day later or whatever it is. Okay, so this is second option. So if it's 1 day or 2 days late, then you have a problem because you cannot meet the reserve. Third option, go and borrow from central bank. We call this discount loan. When you borrow from central bank, we can call it discount loan from the Fed or from central bank. You can borrow and also can be done very fast overnight, no issue. Again, the risk is around quite close to 4%. Okay. And the last option, sell some of this loan to other banks or to other investors from 90 reduced to 81. Okay, so therefore the 9 went to reserve. So the key point is the reserve, right? And if the government changed the reserve requirement percentage, it has got a very immediate impact, right? So of all the 4 options, first option is the one that is most common. When a bank runs short of money, they want to borrow from another bank. Okay, that's the first option. Second option, they will sell from their own securities. Third option, they borrow from central bank, discount loan. Fourth option, they lend it out to other investors. Okay, and here they have to pay interest back. Okay, so these are 4 options for the bank. So every day, the bank do this kind of reserve or liquidity management. We call this liquidity management. Why? Because the fund must be available at the ATM machine, or the fund must be available at the checking account to do payout. Funds must be available. It's called liquidity management. That's the first type of management by the bank. Okay. Can you remember just now there are 4 items? The first one is explained. The second item is talking about asset management. Now, what are the assets of the bank? Their house, their buildings, their cars. Okay, these are assets, fixed asset. But there's also another big asset, which is the loan portion. A loan is an asset to the bank, so they must manage it. How do they manage the loans? First, what are the goals? The goals for asset management of the bank, or for example, loan management, is seek the highest return possible on loans and also highest return on security. Maybe the bank will only buy shares of companies that have good dividend payout, high dividend payout companies. Okay, and also best loans that give the best interest. Now, which bank won't give the best interest to them? Actually, is to a certain extent is mortgage loan, housing loan. Housing loan give very high percentage, okay, of income to the bank. Compare with, let's say, bond rate sometimes is a little bit low. Okay? The second goal is to reduce risk. Therefore, when a bank lend out money, they don't 100% lend out to one company or one individual. They select many people to give out loans to spread the risk. Okay, reduce the risk of spreading to various type of lenders. Third one, make education provision for liquidity. They have to. That's why this one is called excess reserve. You're only supposed to keep 10% in US or 2% in Malaysia for statutory reserve. Some banks actually, in fact, most banks will be more than this percentage, just in case there is a bank run. Okay. So the three goals. So how does the bank? These are three goals. So how does the bank do it? First way. What is the first way? Seek the highest price return. So how do they do that? First way, they try to find borrowers who will pay high interest rate and are likely to default in their loans. Who are these people? Who are those people that is willing to pay higher interest, but basically they can pay back? Now, many of them are actually business. Okay, business people. They like to lend to business because sometimes business suddenly short of funds. But in the long run, this business can pay back. It's a profitable company. Suddenly, the company want to buy extra inventory, extra stocks, or want to buy some new equipment. But this equipment can use to generate income, right, for the company. So banks like to find this kind of people. Okay. Now, it's very strange. When you have a lot of money, the bank will lend to you. When you have no money, the bank will want to lend you. Okay. Second way, for security with bonds, so they look at the interest rate of the bonds. Which interest rate is higher, followed by the risk involved for each of the bonds. Okay, so they can do the calculation. Third way, this way is called diversification. Banks manage the asset by different type of diversification. Okay, so sometimes they will buy bonds, they will buy security, they will give loans. A certain percent is for housing, certain percent is car loan, a certain percent is maybe business loan, a certain portion is credit card loans. So they spread it out and diversify. So that if one party don't pay, at least the other parties can pay. You know, that's called diversification. Okay. So that's called diversification. It's very common. Fourth way, the bank must always manage to come back to reserve. So banks like Maybank have got good contact with CMB Bank, with RHB Bank, Holland Bank. They talk among themselves all the time. Hey, I got extra money. Oh, I don't have enough money. Can I just borrow overnight? So that kind of communication very important. Therefore, relationship within one bank and another bank is very common. They have got very good working relationship banks because each bank know they suddenly may have no money but to have to rely on their competitors. So there's very good relationship. Okay, within banks. Now, liability management. For liability management, over 60% of source of wealth are obtained through checkable demand that by law do not pay interest. So they actually like banks actually like you to open current account because whatever that balance out there, right, you can uh, bank can use the money right? Without paying you an interest. So that's the main thing. Okay. Other than that, after the recession, now the third one is called capital adequacy ratio. Now I'll give you an example if your capital is very low or very high. So there are two banks here. Maybe it's a high capital bank, maybe for example this Maybank, and it's a low capital bank. For example, this is CNB Bank. So now notice the liability here is deposit 90, here is also 96, and the bank capital is 10, and here is 4. The total liability here, low capital is 96 and 4 is 100, and for high capital, total here is also 100, but capital is more. And from this 100, they finance like this, same financing, reserve 10, loans 90, reserve 10, loans 90. Now, what happened? How of this loan? Okay. So, out of this loan, suddenly, this loan people, the 90 million loan people, suddenly they say 5 million of this loan cannot pay back because the company went bankrupt. And the bank give a loan to the company give bankrupt. The bank give the loan of 5. So if the bank give a loan to 5 and the company go bankrupt, so this one become 85, 85. Now, when you have a bankrupt, it becomes bad debt. So if you remember your accounting, debit bad debt, right? Credit account, loans receivable, right? So if that's the case, when you go to the retained earnings will be now from 10 to 5, and from 5 now has become -1. Because last time was how much? Last time the loan bank capital was 4, 5 million was right off, therefore the retained earnings side here will be now shareholder equity now become -1. So if your company have got the -1, auditors will say this is a non-going concern. Then the law will come in. Either you increase your capital or this bank have to go bankrupt. So in the first place, why does bank have the low capital? Now let's say for example the loan here is 90. The loan here is 90. And you get 10% interest, so you get 1 million. Right? So 1 million divided by capital 10 is 10%. 1 million divided by 4 million is 25%. So certain banks want to have shareholders with very high return on equity or return on asset employed. When your earnings per share what also 10%, 9 million, and here 9 million, 10%, both profit is 9 million, but 9 million divided by 10 million or 9 million divided by 4 million. So the earnings per share is different. The share price will be very high, right? 4 times more than this bank. And therefore, the shareholders here are very happy. Because when the share price is very high, when they can sell with a higher price. Unfortunately, is even if out of 90 million, 5 million die, 5 million don't die, your capital becomes minus sign. That is the risk. Okay, that is the risk of too low a capital. Okay. So this is what you mean. Net profit after tax divided by equity capital. So bank high capital or low capital bank, you can see the percentage will be different. So in Malaysia, in order to make sure the bank don't simply go bankrupt, there's a law that's called capital adequacy ratio in Malaysia. If you are a domestic banking group, what a domestic banking group? Maybank, CIMB Bank, Hong Leong, Street Bank, Afiq Bank, or Public Bank, all those banks that you're familiar with, those are domestic. Okay, you need to have 2 billion share capital. The other locally incorporated foreign banks. What is locally incorporated foreign bank? HSBC, UOB, Singapore one, HSBC from UK. HSBC is not from Hong Kong, China. Headquarters is in UK. Standard Chartered Bank, Bank of Standard Chartered Bank, you can find a lot of places. Bank of Tokyo in KL, Bank of Bangkok in KL, right? These are locally incorporated foreign banks. Citibank, very famous Citibank. That share just made 300 million. Why here is 2 billion and here is 300? One reason is very simple. These Malaysian banks got many branches everywhere. They've got many depositors. So when there's a bank run, there are many people will be involved. Okay. Now these locally bank have a lesser branches, so lesser number of depositors. If there's a bank run, they're also not so big impact. And the balance sheet here is very smaller. The last one is standalone investment banks. Like for example, you may have JB Morgan Investment Bank in KL or Goldman Sachs. I don't know where still got it because last time they pay off the 3.2 US because of one MDB. I don't know where still got Goldman Sachs here, but those are investment banks. So what's the difference between an investment bank and a normal bank? Now, a normal bank, they open the door, anybody can come in. Okay, salary with 500, so you can come in, open an account. Investment bank. Investment bank, their depositor is not from the normal raya. It's from huge, big companies and from very rich individuals. So this very huge company as a customer and also very rich individual as a customer, those people don't go and draw out money from the ATM machine or close their account so easily. So therefore, there is very less chance of a bank run. And because of that, and there are even smaller amount of quantity, therefore they still need 500. Okay, because even though they are very lesser, so therefore it should be less than 2, but it's slightly more than 3 because few people are involved, but each of the people, their amount is very huge. Therefore, it should be higher than 300 mil. So they put down there 500 mil. That's the logic. Okay, this is the minimum amount of capital funds. Okay, now the problem is this is the minimum. So most banks will be having more than that as an insurance. Okay. Now the third one that the bank must do, can you remember liquidity, rating of risk, management of assets, okay, managing of risk. The last one is management of credit risk. Okay. So what they mean by credit risk? Okay, credit risk means likely to default on their loans. They don't pay back. How do you manage people like that? So when you have a business loan, some banks will request you to give their annual balance sheet and income statement to them to verify before they continue extending the loan. If you are an individual, they may say you must take out the insurance policy or do a medical test yearly. Or they may say, okay, you borrow money from the bank for your housing, right? Your housing name must be under the bank name until you pay off all the loans. Okay, or some banks say, I lend you 10 million, 2 million of which you must put back into the bank as a safe deposit. That means you want to borrow 10, we give you 10, 2 million you must give back as deposit. Therefore, net, the bank is only lending you 8 million. Okay, at 8%, and your 2 million deposit is given back to you at maybe 4%. So the bank make a net profit of 4% on the 2 million fixed deposit you must put back as a safety measure. Okay. So far, Nora, any question? Eunice?
No.
No,
clear?
everything clear.
Okay. Tarani, any question? Uma, any question?
No, sir.
No, sir.
Wait. I want to download the attendance first. Okay. So I continue, huh? Now, one way, of course, for credit risk, they're screening and monitoring you. If you are working, show me uh, 10 months or 1 year payroll slip or EPF slip, or they sometimes ask you, give me your income tax statement. So that's called screening. Okay? Or if you are a company, they will look at your accounts in the audit opinion, whether your account is a going concern or not. They look at your audited accounts to see where is your income and your balance sheet. They will calculate all the accounting ratio. For example, the solvency ratio, right? Or current assets ratio, okay? Working capital ratio, okay? Inventory turnover ratio. These are all used for, all those accounting ratio is used by the bank to screen, to check whether you are a good lender or not a good lender. Okay? And they keep on monitoring you. Ask you for a yearly account. Okay? Screening, nothing much. The bank always like to have a long-term relationship. Uh, the banks like to lend back to if possible, the same person. So let's say you take a loan, you pay off already, you have a good record that you pay off. So when you apply for second loan, maybe they'll be happy. Once you pay off the second loan, okay, you want to apply for third loan, the bank will be happy to give to you. This is called long-term relationship. Okay, because they see you have a good history of paying back the loans. Collateral compensation, just like I already explained already. Credit rationing occurs when the lender, the bank, refuse to make a loan of any amount to a borrower. Because, for example, maybe you're blacklisted or you're a criminal. You're a criminal, maybe the bank won't give you a loan. Or you're a bankrupt, the bank won't give you a loan. Okay? Even though you want to pay a higher interest rate. Okay? Like, for example, you are now in jail. If you're in jail right now, the bank will never give you a loan. Right? Okay? Next, another type of restriction is that the bank is willing to make a loan but restrict the size of the loan. You apply for 10 million, you're only going to give you only 4 million. They restrict you. So the other 6 million, you may have to go and find another bank. Or you cannot buy the 10 million house, you can only buy a 4 million house. That's all. They restrict the loan. So this is called credit rationing. That is a form of risk management. Okay. Other than that, okay, now we can change the balance sheet. Instead of putting a fixed asset and a current asset, or a long-term liability, short-term liability, we will now use the amount here and classify those assets that have rate sensitive asset. What are rate sensitive assets? The total is still 100 million. Maybe here is the reserve and cash, and here is loans. But now they rephrase it into this type of rate sensitive and fixed rate asset, and liability also rate sensitive liability and fixed rate liability. So these are the components of item which is rate sensitive. Okay, for asset and liabilities is an item, and the balance is fixed asset. Now, this is called capital adequacy ratio. Now, why do they do that? Because there's a formula. Okay, in many countries, of course, also in Malaysia. Malaysia, I think, is 8%. How do you calculate the ratio? This minus this times by the difference of the interest rate. That's the ratio. We call it the gap analysis, right? Present change in market value of security, okay, minus percentage change in the market value of the security. This minus this, what's the percentage change? A minus percentage point change in, okay, denotes approximately equals, okay. So this is the gap. What is it? The gap formula here. I think it shows better. Where's the gap formula? I think it's shown in the explanation here. You have to read through the explanation. So what it means is that the difference between this, So let's say now here is 20 and here is 50, right? So here minus here is how many? 30. Okay, so what's the change? So 30 over 50, so this is the change of percentage, right? And here the interest rate here, interest rate, the change in interest rate. So here is a minus sign, percentage times, of course, here is the liability, here is the cheaper interest rate, here is a higher exchange interest rate because it's loan. So whatever you calculate must be at least have 8%. Okay, that logic is that you must have enough capital. So if your capital here is more, here will be less than, understand? Okay, if you have more capital here, here will be less. If here is less, therefore a lot of capital is used to finance the loans. If a lot of capital is used to finance the loan, not so bad, right? Okay, so it should be at least 8%. If below 8%, Bank Negara will ask you to increase the capital. Okay. So please read this one. Capital adequacy ratio. Now, other activity of a bank, sometimes they use off-balance sheet activity. Then these activities not covered by the above. Okay. So there are many types of activities that a bank do. First one, loan sales. When you have a loan, when a bank have a loan, the bank can sell this loan to investors. That's all, right? So when the bank sell your loan to investor, therefore the bank have to pay the investor interest. So let's say you borrow from the bank charge you 8%. Understand? You borrow from the bank charge you 8%. Now your bank may take your loan and sell it to the investor, and you give the investor 6%. Therefore, the bank have a net gain of 2% without exposure, without risk, right? That's for loan sales. Fee income. Okay, when you do forex with a bank, there's a charge. Servicing a mortgage bank security. When you have a housing loan, they will charge you administrative fee, this and that. A lot of fees. When you open a current account, yearly there's a fee, right? Backup line of credit, guaranteed debt securities. This is the opposite. When you are a bank, you have a lot of money. Other banks don't have money, want to give you your loans, you'll get income. Okay, you're an investor. Not a bank become an investor, you get some income. The last one is line of backup lines of credit. Now, what is called backup lines of credit? The bank will give you a line of credit. You're a business. You want to do some business, you suddenly don't have enough money. Maybe they give you, for example, overdraft up to 10 million. That's called a piece of credit. Get an example. So you have not borrowed yet. In case you want to borrow money, see, when you're a business, you don't know, suddenly you may want some money, and you want to negotiate with a bank to lend you money, it takes a long time. Okay, you have to give all the documents for the bank must go through all your balance sheet, income statement, right? That will take time for them to approve your loan, but suddenly you need money. So many companies actually open a LC with the bank. And the LC is the bank say, okay, I stand by ready 10 million for you. Anytime you can use. Right? If you use, we charge you 8%. Right? If you don't use, most banks charge you 1%. So let's say, for example, the bank give you 10 million LC. Right? You use up 8 million. 10 million standby for you to use, you use 8 million. So 8 million, they charge you 8%. The other 2 million that you never use, they charge you 1%. Why? Because the bank say that, oh, I made ready for you now the extra 2 million. If you are used, you pay me 8 million. But if you don't use, I the bank lose, no, I reserve the money for you and you don't use, I cannot charge interest. So therefore, we give you 1%. Okay, they will charge you 1%. Now, in actual practice, how does this work? Exactly what I say. If you're a small businessman, but if you're a big businessman, how do you negotiate with the bank? These are all come from practical, okay? If you're, last time when I was working in Sony, I was the director of finance. Bank of Tokyo want to give me a line of credit. Okay, no problem. Give me a line of credit in case suddenly I need some money, right? So they say, okay, how much you want? Up to you. Give me 10 million. So they say they will charge me 1% per year on unused portion. So if I got standby 10 million, if I don't use, every year I must give Bank of Tokyo 100K. So I negotiate with Bank of Tokyo. I am from Sony. I asked Sony headquarters to give you a letter of guarantee that if I use the 10 million and if I don't pay back, Sony Tokyo will pay you back the 10 million plus interest. So Bank of Tokyo very happy. Bank of Tokyo in Lebo Ampang, KL. Okay, Jalan Lebo Ampang, KL. So they're very happy they can get a letter of guarantee from Sony headquarters in Japan. They still got 1%, isn't it? Because that's by law. So I make a deal with Bank of Tokyo. You give me a standby, 1 ringgit. And every year, if I don't use, the whole 1 ringgit will charge me 1% of 1% of 1 ringgit is only 1 cent. But because I got a letter for 1 million, that the bank can easily change to 10 million immediately. I make one phone call. Hey, change the letter from 1 million to 10 million, because, okay, I need the money now. Okay, and we already got a letter of guarantee from Sony Corp headquarters. Can you see how practical is different from theory? The law and theory say it is 1% of unutilized fund. So you have to play around with it. Play until the letter of LC is only 1 ringgit, with the understanding can be suddenly increased. Suddenly increase means what now? Within 10 minutes, understand? Okay, so these are all the practical things. Now, if you are a small company, they are not going to bother about you. You want to lend money, okay, you want to have LC, can. Provided you are a good company, they give you LC. Provided they charge you another 1% on unutilized fund. But if you are a big company, you negotiate with the bank, right? If you are working for Malaysian Airlines or working for Genting, we are a very big guarantee company, okay? So the branch, Genting, will borrow for LC and ask Genting headquarters to give a letter of guarantee, provided the bank agrees. Therefore, you don't have figure so big, 1% on unutilized fund. 10 million is already 100K. You understand? It's a big money, right? You don't use the money, but you want to have a standby. That's why the word is called standby. Okay, standby LC, just in case you need money. Why do you suddenly in case you need money? Like I say, just in case emergency, you don't have enough money, so you may need to have borrow money, right? And you cannot borrow from other banks so easily because you're a company. You're not bank to bank borrowing, right? So this is what you should do. You have to learn, you have to read between the line and see what is available in the market and how you can make advantage of it to the good for your company. Now, is there any question on this particular chapter? Any question? How does bank do their job? What other?
No, sir.
Everything very clear. Who is that? Eunice, Eunice, you sound very tired. Eunice, what's wrong with you? Uma? Uma, any question?
No, sir.
Emma?
No, sir.
Everything okay? So far, no question, huh? Okay.
So far, no, sir.
You can understand what I'm saying, huh?
Yeah.
Okay, now 3 o'clock. We take a 5 minutes break before we proceed the next chapter, which will finish at 4 o'clock. We take a 5 minutes break. Now it's 3 o'clock. Come back at 3:05 on the dot. Okay? Thank you.
Okay, so
Okay, welcome back. Can you hear me? Say something. Eunice, say something.
Yeah, I can hear you.
Okay, just before I forget, so from last chapter, about the bank management thing, now you can take advantage, right? One is called the what's the name for it again? Unutilized, okay, so unutilized, you standby. So actually, the first one is actually a standby credit. You have to ask the bank to give you wrong spelling. First, you have to ask the bank to give you a standby bank credit. It means that the bank reserves some money for you to borrow, right? Because if suddenly you need money, right? If suddenly you need money and then who's going to lend to you? You increase the share capital takes time. Investor must come in, okay? Or new shareholders must find. You will try to sell your assets, whether current asset or fixed asset, sometimes also need time. So many companies actually try to use this thing called a standby credit. Therefore, before the crisis appear, right, the business really discussed with the bank, can you give me a standby a line, okay, a standby bank credit line, whatever the amount of 10 million or 5 million or whatever it is, right? Bank will give to you, of course, they will review your economics data, and they think you're a good lender, they will give you. And for standby, so just want to make sure you understand. So let's say standby is 10 million. So okay, so if you use 8 million, then the interest rate may be high, say 2%, right? Unused, in this case, will be 2 million, and they want to have normally, okay, I think there's no law, but within banks recently, okay, so they want to pay interest unused rate at 1%. Where's the percent sign? So if you unused 10 million, okay, therefore you will have to pay 100K lah. There's a big amount, right? So this is not teaching books. This is come from practical. What you can do is you should negotiate with bank, standby, ringgit, okay, with understanding that the amount can go to 10 million whenever needed. The bank will now ask you to do that. You give to the bank a letter of guarantee from your HQ. Okay? And maybe they'll give to you. Okay? That's one thing. Huh? The second thing is that bank must have reserve 2%. Okay? Daily. Okay? At the end of the working day. Now, you know, right? Suddenly, some bank will be short. So they will borrow, okay, short bank, borrow from stronger bank to get short bank, borrow from stronger bank to in order to top up to minimum 2%. Here comes the trick. If your company have excess money in your current account, you do a revolving credit for 1 day with some low interest, because in your saving, in your in your checking account, there is no interest paid by the bank. So you want to get some interest paid by the bank, you can ask the bank to reverse out from your current account to go into a RC, revolving credit. What RC stands for? Revolving credit. So this amount, when you take out from your current account, the bank will use this money to lend to other banks, which is short of 2%. So even though your checking account got no interest, but you must move the money out. So you actually have to give a letter, and then you just scan your letter and send to them. So early in the morning, you call your bank, hey, I want to do revolving credit. How much will you accept? Oh, they say they accept 100 million. Oh, I don't have 100 million. I only got 3 million. Can I park in a 3 million revolving credit, take out from my current account to go to you? Okay, what's the interest rate? They'll tell you. They agree. Then you type out a letter, the standard format. They will give you a format, no issue. Then you just send out the amount, and then your current account balance will be dropped by 3 million. And this amount will be given back to you tomorrow with the interest, small interest, better than nothing. Is that understood? Hello? Nora?
Yeah,
You are running a business, isn't it?
previously.
You heard of this thing called standby credit?
I don't do loans, you know, I have enough cash to run my business.
Okay. If you have enough cash in your current account, do you do revolving credit? You don't know.
No, I don't do any what revolving credit, no.
Okay. If next time you got extra money in your checking account, you can do a revolving credit. Saving account got interest, small interest. Current account, there's no interest given by the bank. So you have to do revolving credit for your current account. Okay. So these are all the practical tips. So for the other rest of you students, you're all maybe working in some company, please consider these two. You want to borrow money, stand by. Okay. The other thing is if you got extra money in your current account, ask the bank to do a revolving credit. Normally they come in multiples, not stand multiples of million, either 1 million or 2 million or 3 million. They won't do funny sum. Okay. Okay, now I want to talk about this chapter, central bank and the Federal Reserve System. Central bank is like a government bank in Malaysia. In Malaysia, we call it as Bank Negara. So now I want to explain to you using Excel to summarize. Okay. Now, what does the government want? The government wants, what do they want? To be in power. Hopefully forever. How to do that? Oh, we will do this way better. The government to be in power forever. How to do that? Get rakyat to work for them. Every 4 years lah, maybe in Malaysia, other country, I don't know lah. Get rakyat to work for them lah. Now, what does the rakyat want? Low or zero inflation and full employment or business they have and run business all the time. So government use what? Fiscal policies. And what are fiscal policy? Government spending or tax rates. Increase the tax or reduce the tax rate. Okay? Government spending, increase spending or reduce spending. The other way for the government to do that is called monetary policy. How do they example monetary policy? Basically, control money supply in the market. For this one, they use the central bank, or in this case for us, we use the Bank Negara actions. Okay, so far understand?
Yeah.
So the Bank Negara is actually an agent. It's like not secret agent lah. Kuli lah. The Bank Negara is a kuli for the for the government. So depending on you, what do you want, right? You want low inflation? If you want low inflation, the government will use Bank Negara through money policy to reduce inflation. What do you want? You want employment? So the government will use Bank Negara by controlling the money supply to generate employment. That's all. Understand? So now, the key point now is the Bank Negara. Now, what did you do? You are the rakyat. What do? You do voting, correct? Whichever party lah. You voting for the party, hoping the party can win, then the party will appoint the PM. Understand? Now the party will appoint the Prime Minister. Yeah. It's not too big space, not enough space. Party appoint the PM. Okay? So party appoint the PM. PM recommend the board of director for Bank Negara. Okay? This is the board of directors, BOD lah. I don't have so long, so column not big enough. Okay? PM recommend board of directors to the Yang di-Pertuan Agong Prime Minister appoint board of directors. Two different ways. Prime Minister recommend to the Agong who will be the mayor, who will be the BOD of Bank Negara. Now you understand. So what does that mean? If you are a Bank Negara person, you want to become a board of director of Bank Negara, you may have to follow what the PM says. If you don't follow what the PM says, PM will recommend to Agong to kick you off from the board of director and bring in another person. Understand? So this one we say democracy. Why we say democracy? Why we say democracy? Very simple. We appoint the party who appoint the Prime Minister. Understand? Therefore, the Prime Minister is acting as an agent for the rakyat. We, the rakyat, vote for the whichever political party, and the political party appoint the Prime Minister. The Prime Minister recommend to the Agong who should be the members of the board of director of Bank Negara. So if you want to become the director of Bank Negara, you have to listen to the wishes of the Prime Minister. Very simple. So it's called democracy. This is the way for all the central banks in the world. Not only Bank Negara, every country. Bank of England, Bank of Canada, Bank of Japan, Bank of whatever bank lah. Okay? Monetary Authority of Singapore, all these central banks, they all listen to their political masters. And the political master listen to the rakyat, because the rakyat always do voting every 4 years. And we say this is democracy, because we elect the party that elect the Prime Minister recommend. So Prime Minister acting on the rakyat behalf, recommend who should be the directors of Bank Negara, and Bank Negara, those directors will take instruction and act based on the wishes of the government, whether which is to follow the wishes of the rakyat, whether to do inflation or to do full employment. Understand? Now, so far, any problem? Can you understand?
Yes, sir.
Now we look at the American method. American method a little bit different. Okay. Here, it's different. We say here, the rakyat. In America, it's different. In America, they have 4,236 member banks. So what is a member bank? Company, a bank. Maybank. These are banks. CIB bank. But in US, we use the word member bank only for US bank. So if Maybank opened a branch in New York, it's not a member bank in USA. It's a domestic incorporated in US owned by a foreigner, which in this case is Malaysians. Right? Same. Can you remember just now the capital adequacy type of banks? These are, in other words, you can use the word domestic. And do you know how many banks there are in the US? 4,000 over. Okay, now they will vote for the not Bank Negara. They will vote for the Fed, Federal Reserve. Tell me the full word. Vote for the members, vote for the board of directors of the Federal Reserve Bank. First, straight away you notice something is different. The Federal Reserve Bank is not a government bank. The Federal Reserve Bank is a private bank. It's a private company. So the Federal Reserve Bank is actually a private company. Okay? And if the Federal Reserve Bank make profit, the dividend will go back to the domestic bank. It's like a company under company law. Okay? So this is nothing to do with democracy. There is no democracy. Because no. So this is a private company. The president or Congress is the parliament in the US. It composed of upper and lower body. One is the House of Representatives and one is the Senator. Senator is like the House of Lords and the House of Representatives is like our Dewan Rakyat, right? And the Senator is Dewan Senate. Okay, so President or Congress, no control over the Fed. There's no control. So you can say there's no democracy. So aim of the Fed is to make profit. Aim of the Fed is to make profit for its how many people? 4, 2, 3, 6 members by using monetary policy. So the Fed do not do fiscal policy. They cannot do. The government can do government spending and tax rate. The Fed cannot do fiscal policy. The Fed can do monetary policy, control money supply. So how do they control money supply? For both, whether you are Bank Negara or you are the Fed, you control money supply by three methods. One is the open market operation, buy and sell bonds. Second is the discount loan. And the third is moving the statutory reserve rate. Okay. So now you can see here, there are two systems in the world. One is the Rakyat way of doing. It's done by the 99.9% of all the countries. And here comes another joker from US which follow the other way now. But they have big control. They are controlling the money supply. So which way is better? Some people say, hey, this way better. Hey, all right. This way is better because we, the Rakyat, work for the party appoint the PM is acting on the Rakyat behalf. And for saying the Bank Negara to do action that's what the Rakyat wants, which is low inflation, high employment. Only problem is with this way, how can we trust the PM? After election already, he will do whatever he want to do, isn't it? He got his own political agenda, right? If the PM is good, then no problem. If the PM is not good, we have a big problem. So this method got plus and minus. Now let's look at this method. This is not even controlled by the government. This is a private company. Is this good? It's good because it's good for the members. Is it good for the rest of the US citizens? Because Fed is ultimately responsible for their members' bank. These are shareholders. So it's not good because there's no democracy, but it's good because they are not controlled by the government. Because if government, like here, what's the bad thing about here? The government no good, so they are not being controlled by a no good government. But also same thing. What is it to stop the Fed do crazy things? So whether here do crazy thing or the Fed do crazy thing, right? Either way, whether it's democracy or no democracy, the key point is, it doesn't matter whether there's democracy or no democracy. The key point is whether the board of directors in Bank Negara and the board of directors in Federal Reserve Bank, are they doing the correct job? Now you may say, Rakyat one, very clear, low inflation, high employment. Here, their goals are different. Nothing to do with this private company don't care whether US got low employment or high inflation. The only way they care is that they still follow. Why? Because if the economy is good, all these domestic banks will make profit by lending. So in other words, the Federal Reserve is acting like as if on behalf of the government because they have an interest that the economy become good in terms of unemployment and inflation, so that their members can do good business and make good profit. Is that understood? Which way is better? There is no right answer. Umar, understand?
Yes, sir.
So, you think which way better? The central bank way or the Federal Reserve? Umar?
I think both.
You think both are good? Well, it depends on the situation. Whether the government is good or whether the Fed is good. That's all only. So the matter
Yes,
whether
sir.
it's democracy or no democracy is some people make up this kind of story to say which is better. That's all. Okay, that is precisely the point. Okay, precisely the point. So you must remember for Bank Negara, they are appointed based on the recommendation of PM. So the PM say do this, they do this. PM say do that, they do that. Okay, so if the PM no good, we have a problem. That's all, right? So same as Federal Reserve. Federal Reserve is based on their directors. If they do good, it's good. If they do bad, it's bad. That's all only. So, but the recent one is the European Union Bank. Now, in every country, in France, in Italy, Greece, all those countries in the European Union, they have their own central bank. And each of the countries' central bank report to a European Union Bank. And the European Union Bank follow this method. So instead, in the European member, I think they got 26 countries, so they got 26 domestic members banks. But in US, they got 4,000 domestic banks. Okay, so it seems that there's a trend that following the Federal Reserve way is better, as can see from the European Union, because European Union is the, can I say, the newest of the central bank, and they choose to follow this way. Okay, it's hard to say. Okay, which way is better? Okay, which way is better? To be controlled by politician or to be controlled by a private company that wants to make profit. So that is our other members banks that make profit. And in order for all the other banks to make profit, the economy must be good. So Federal Reserve do action, do monetary policy action to make sure that their members, to make sure the economy is good, so that the domestic member bank is is good. Now when I talk about domestic member bank, I'm not talking about branches. If you're inclusive of branches, maybe you have 20,000 or 30,000 banks. We're just talking, for example, one bank, Bank of New York. That's one bank. But if the Bank of New York maybe got branches in California, Nevada, or Tennessee, that branches is not counted. So you can see in US there's so many banks, so many unique banks. Okay, so we'll continue now. So central banks. So this set up a central bank is by law. So all central banks are set up by law. Okay, by law. That's why it's democracy. Okay. In Malaysia, we have this governor and chairman, 3 deputy governors, secretary general of the Khazanah, and 6 directors. Now we look carefully. It's very strange. How many people you got? 1, 4, 5, 6, 11 people are the directors of the central bank. Okay, all members except the deputy governor are appointed by the Majesty. Okay, the Yang di-Pertuan on the recommendation. So all except the deputy governor. So this one, excluding this one, these are, except for this one, 1, 2, 8. 8 out of 11 is appointed by their Agong, Yang di-Pertuan Agong. Okay, on the recommendation of the Prime Minister. And this one, the 3, appointed by the Minister of Finance. Guess who's the Minister of Finance? Kementerian Keuangan. The Kementerian Keuangan, the Ministry, the Minister of Finance is a cabinet position. Who appoints the cabinet? The Prime Minister. In other words, that the Agong can appoint 1, 2, and 8 on recommendation. Can the Agong refuse the recommendation of Prime Minister? Never see before. They always follow. Because the Agong is the head of the country, but the governing of the based on our Malaysian constitution is passed to the Prime Minister. So far, the Agong always follow the recommendation of the Prime Minister. The other 3 is controlled by the Kementerian Keuangan, which is also a cabinet minister, which is also appointed by the prime minister. So if the Menteri Keuangan don't ikut the prime minister is sack the burger and bring another minister of finance. So in other words, all the board of directors are controlled by the prime minister. Now, do they change often? How many chairmen have we got in Malaysia? I cannot remember. That's not how many past chairmen are there in Malaysia? I don't think many. Past chairman. Past chairman and members. So how many years? 1957. Now how many years? 67 years. Okay. So 1, 2, 3, 4, 5. Okay. Past chairman and members. So no. This is one. Recent one is Talib. This one I think the thing is wrong already. Talib. You have to count lah. Because they count all they show like this, you have to count. Talib, 1. Or they go through many way. I don't think got many. Abdul Talib, Mokhtar, so 2. Mokhtar bin Abdullah, same. Tan Sri. Datuk Anon, Sri Anon, same. 3. Patale, Panglima. Got a few lah. Because every year also. Because every year they have because Prime Minister always give every year. I think this is not a very good side. Past chairman, legal professional, role of president, parliament, history, Suruhanjaya Pilihan Raya, history of the election commission, board of chairman. You know, come from there, Pendagaran. 10 governors. Okay, since 1959 there were 10 governors. So we are now 67 years independent. So 67 years, we got 10. Average one, 67 divided by 10. How many? About every 6 years to 7 years, average lah, new chairman. Okay, we got 10 of them. Anything else? Okay, that's about it. Roles and function, economic and monetary policy, investment and operations. What else? Regulation. Here, Bank Negara give regulations to the commercial banks. For example, statutory reserve. For example, they will give you the capital adequacy ratio. Okay, CAR. Payment system, Bank Negara also do. This will be part of your economics when you do trading overseas, whether you buy or sell. All payment must go to Bank Negara. Okay. You go to your bank go to Bank Negara, then you go to the other central bank over the other side. Supervision of commercial banks, communication of any reported information, so forth. Okay, so this is a balance sheet 2022. This is a Bank Negara balance sheet. So Bank Negara also got one thing you notice that is the gold reserve. They are holding some gold and exchange. Why are they holding the foreign exchange? Because when you do trading with the normal business, when you do trading in the overseas, Bank Negara must have that enough exchange, because you are giving money in ringgit, and if you are buying something, you're giving money in ringgit, and Bank Negara will change that one to US dollar to pay to the US side in US dollar, because their side they want to deal in US dollar and you want to deal in ringgit. Okay, so this is just the balance sheet. Okay, I want to show you some key data. Statutory reserve 2%. Overnight policy for interbanking borrowing to top up the 2% is 3%. CAR ratio 8% minimum, risk weighted, 4 type of risk. Inflation -1 2020 COVID lah. Then after that, normally it's around 3%. I think Malaysian inflation is quite good. Okay, it's always around 3%. GDP growth Here minus lah, probably other than good jump. Then I think will be carried on. 2023 forecast. They haven't come out the latest figure yet, the actual figure. Now it's only February. They have not announced it, so they have just put a forecast. It's quite close to around 5 or 6%. It's quite good. But there are certain countries many years are 10%, above 10%. China. That's why China is growing so good. Over the I think past 20 years or 30 years, they have annual GDP growth about above 10%. Okay. Anything, okay. Now we talk about, so you understand the what the Bank Negara. I will go back here again. So let's see. I think I've drawn before, so I just want to repeat to you. Let's say now the government wants to have low inflation. Inflation very high means a lot of money in the market. A lot of money in the market. So to bring down inflation, we must reduce the money in the market. So how to reduce the money in the market? Bank Negara must take out all the excess money. How to Bank Negara take out all the excess money in the market? Bank Negara sell bonds. Sorry. Bank Negara buy bonds. When Bank Negara buy bond, you will give your money to go and buy the bond, which is a certificate, right? So the money is taken out from the market. That will reduce inflation. Now, if they want to have full employment, so now Bank Negara will do what? Bank Negara now sell bonds. So when the Bank Negara sell bonds, all the money will be given back to the market. Therefore, the market will have more money. People will do more investment, right? When people do more investment, hopefully employment will go up. That's Bank Negara action. Now, the same type of action also will taken by Fed. The Fed will actually now is talking about inflation because US inflation is very high, right? US inflation is very high, so the Fed is doing something about inflation. One of the ways they can do is, of course, open market. Okay? Another way is, of course, interest rate, but I don't want to link that one now. So, Bank Negara will have open market department. Now, when you use the word open market, the word open market is the market is open, they buy and sell. That's all. Okay. So open market department. Now, in Federal Reserve, now remember there are 4,000 over banks, right? So we look at this. So we have a lot of member banks. They will vote for the 12 Federal Reserve banks, and from the 12 Federal Reserve bank, they will appoint board of governors, which you got 7 members here, chair appointed. This is a figuratively appointed one. There's no control one. Okay. So the board of directors, 12 Reserve Bank. In other words, they got 12 central banks, all owned by, I think here's the wrong typing already. It should be latest because this one is an old picture. It should be around 4,002. Okay. So they go open market operation to sell and buy bonds. That's all. That is the one way. So you can see in US, they got 12 regions. Okay, 12 regions. Now you will notice why there are a lot of regions, central bank district, or they call it, there are 12 of them. You can see 1, 2, 3, 4, 5, 6, okay, and 7 and 8. So our 12, 8 is on the East Coast because they are the first one to start the state of USA. California, all these come much later. California, Texas, they came later. That's why they have lesser central Federal Reserve District. Now, the board of directors is sitting in Washington, capital of US, and they got Federal Reserve Bank cities. Now, you may have one district, but some more few banks. And each of these banks is called the Federal Reserve Bank City. Right? They come up a lot of statistics one. Okay. Then you got branch some more. Oh, black color la, blue color la. Blue one is one for each la. The black one is more. One district you may have a few blacks. Okay. The 3 largest one is in New York, Chicago, and San Francisco. Actually, New York is the one that plays a lot. When New York do something, Federal Reserve Bank, New York do something, the rest of them all follow. So the chairman of the New York one is very powerful. Okay. 18. So they do the same thing, buying and selling bonds to control the money supply. You must remember, monetary policy relates to money supply. We have the word monetary, okay? Fiscal policy is controlled by the government. It's on taxation rates, reduce or increase the tax rate. That's got an impact on the money supply, but they use the percentage of rate. Okay, and the next one is they're using the government spending, increase spending or reduce spending. Okay, or diverts from one industry to another industry, that kind of spending. But monetary policy basically is on three things: bonds, buy and sell. This is the most common. The other one, discount loan rate, and also what's the other one again? Statutory reserve rate. These are seldom used because the impact is very huge. They don't change. Okay, we don't normally change the SSR and discount loan rate. Discount loan rate is a central bank lending rate to the banks, to commercial banks. Other than that, there's nothing much. Now, the key point is why do we want to okay, let's go for independence. Now, this is for and against independence. That's democracy or not. Okay. Now, other central banks, Bank of Canada for the first one. So it was founded, and he got his board of governor, 3-year term period. Okay, the Bank Act was amended to give ultimate responsibility for government to the government. Therefore, the Bank of Canada must listen to the government. Bank of Canada. Bank of England, Bank Act 1946 give the government authority over Bank of England. Okay, the original name for Bank of England is actually the Exchequer. So if you're the head of you call it the Chancellor. The new name is the Bank of England. The old name is actually the Exchequer, but the chairman is still having the old name, Chancellor of Exchequer. Okay, that is England. Japan. So the new Bank of Japan law. Okay, Bank of Japan. There's a lot of independence given to the Bank of Japan. Unfortunately, okay, the government is controlling the budget of the Bank of Japan. So they can increase or reduce the budget of Bank of Japan. Therefore, Bank of Japan is under a lot of pressure to follow the government. There's no law. There's no law in Japan, but the government controls the budget. European Central Bank, they basically follow the one? The state Federal Reserve System. Okay. Now, why do we study the Federal Reserve System? Who cares? Right? We just care about Bank Negara is nothing. We are Malaysia. Man. The point is, the reason we study Federal Reserve System is because whenever Fed do, it affects the world. There used to be a quotation. Okay? When the Fed cough, the rest of us feel cold. Because the economy in US is so big. They are the main importer and also a very major exporter. A lot of business are in the US. They are very strong politically. They are very strong military. They have the most nuclear bombs, most submarines, fighter jets. That is a military. The economy, they are very strong because they have a lot of money. IMF Bank, World Bank, these are all controlled by the American government. Okay? So they are very strong. And because now the world is connected by internet, there are a lot of banking movements from one country to another country. Right? Everything is being controlled a lot by the US dollar. And the oil price is negotiated and paid in US dollar. Now, you must understand, if Malaysia wants to buy petrol or buy oil, of course, Malaysia have their own oil, but if Malaysia don't have enough oil, they have to buy from maybe Saudi Arabia or Iran. They have to pay for in US dollar. Why not Saudi Arabia Riyal? Why US dollar? Because Saudi Arabia make a contract with the US. The US will protect the Saudi Arabia kingdom from invaders. In return, Saudi Arabia oil must be quoted in US dollar. So this is the contract. US people will protect Saudi Arabia kingdom from attack, provided Saudi Arabia oil is quoted in US dollar. And Saudi Arabia is the greatest producer of oil in the world. Right? Now, here's the key point. When everything in oil is controlled in US dollar, guess who is controlling US dollar? The US government. Who can print US dollar? The US government. So now everybody is very worried about the US people printing so much money. So we have the thing called BRICS, B-R-I-C-S, Brazil, Russia, India, China, South Africa. These countries form all together and they are trying to now selling oil or other export-import in their own currency. Okay? Dubai is selling their oil in Dubai. What's the currency name? Dirham, right? Iran is selling theirs in the Iran currency. USSR, sanctioned by US, cannot use US dollar. So USSR is paid based on rupees, which they are collecting from India. India buying oil from Russia. They are using the Indian rupee or the Russian rupee. Rupees. Okay, so a lot of people are moving on from the US currency. It takes time. So in the meantime, US is the biggest economy, economically, most important in military, most important currency, the US dollar. So when the Fed moves the interest rate, move the bond buying and selling, the rest of the world are affected. Okay, so you cannot just study economics or money and banking without considering the US impact on the world. That's why now we are studying the Federal Reserve System. Now, is there any question you'd like to ask me? Everybody understand? Tarani, do you understand? Any question?
No, sir.
Ezekiel, do you understand? Is it too difficult for you to understand? Nora, any question?
No, sir.
Okay, if there's no more question, I will stop sharing. Okay, and I will see you tomorrow at 2 o'clock. Okay?
Okay, sir.
Okay.
Okay.
Stop on time, huh? Okay.